And good morning once again, options traders. And even though the volatility has been falling here in the later stages of coronavirus, they're still at pretty high levels, especially for some of the stocks. And that's what's leading a lot of the traders to sell options. It could be from covered calls, it could be diagonal spreads, any number of strategies where you're selling an option as part of a premium collection strategy. But a question that comes up all the time is, when do you receive an option premium? And depending on who you ask, you're going to get different answers. Some people say, oh yeah, you get it immediately. Others say, no, you don't get it until expiration. And technically, both answers are correct. It just depends on how you look at it. It can be a very confusing source for new traders. So let's find out when you actually receive an option premium. So first, for a little bit of history, remember that option selling is also called writing the option. You're the option writer, and that just comes really from the insurance world. A lot of the terms in options trading were kind of borrowed from the insurance industry, and writing is one of them. Premium is another. You pay a premium for an insurance policy. You pay a premium for an option. And just like if you buy a policy from an insurance company, they write the policy. They're the ones that are accepting the obligation in exchange for the cash. And that's exactly what you do when you're writing an option, whether it's a call or a put. So yes, you do receive cash, but then you have an obligation of some kind. You will have an obligation to sell in the case of a call. You'll have the obligation to buy in the case of a put. But again, the question is, when do you actually receive the money? Well, here's where it gets a little tricky. You receive it immediately, but it's not realized until expiration. So that sounds like, what are you talking about here? So let's go through a covered call example, and it should make a lot more sense. So let's say we're doing a covered call, and to make it simple, you opened up a brand new account. So you've got nothing else in here to track to make things more complicated. So you open this account and you deposit $10,000 cash. So at this moment, your account shows $10,000 cash, 0 positions in stock and 0 in options, and your total account value is $10,000. And so now you say, let me buy 100 shares of stock trading for 100. It's going to cost you $10,000. What happens now? Now your account is going to show that you have 0 in cash. It's all been shifted over into stock. You own 100 shares. Your platform's going to show plus 100. So yes, your total account value is still $10,000. You've just shifted it from the cash to stock. And now you say, let me sell an ABC call for $2. And what you're thinking is that your total account value is going to immediately jump to $10,200 because you received $200 cash. So you sell this call, you get filled at 2, and you look at your account and you find that the total account value is unchanged. So what happened? Why didn't you get the cash? Well, again, here's where it gets a little fuzzy. You did receive the cash immediately. It's sitting over here in your money market. Your cash is now increased from 0 to plus 200. And unfortunately, this is where traders think that the whole story ends and that this should now be reflected in their balances. But remember, you sold an option. You're going to show -1 of whatever this option is. Microsoft, NVIDIA, whatever it happens to be, it's going to show -1 because you sold an option that is not in your account. So that's why it shows -1. That's a short option, and it's an obligation. So you can't just collect the cash and walk away from the obligation. We have to wait for this obligation to disappear. So right now the broker is going to say the obligation is also valued at $200. That's the price that you just sold it at. In other words, if you wanted to escape your obligations right now, it would cost you $200 to get out of the contract. So they're going to account for that in the positions. So notice that your total account value is just the sum of these 3 positions. So it's this -200 right here that's canceling out the $200 cash. So when are you going to start seeing it reflected in your balances? Well, this is why you have to wait for time to pass. We have to assume that this options price is going to bleed away from the passage of time. So for the example, let's say if the stock price stays the same, time passes and the call's value is going to drop. This is just from theta, time decay. So let's say that the market value is no longer $2 on this option, but it's now fallen to $1.50. So your broker's platform is going to show that your obligation is $150. The $200 cash doesn't change, and now you're going to see it reflected in your balances. Now you'll see your account value go to $10,050. What happens next? More time passes. The options value falls some more. It's now worth $1 or $100 per contract. So your broker's platform shows that this obligation is minus $100 for you, because again, that's what it would cost right now to close this position. The value of the cash doesn't change, and so the net between these two is $100, and now that gets reflected in your total account value. More time goes by. What happens? Option bleeds away some more. Now it's worth $50. Paired against the $200 cash, now your account value shows $10,150. And finally, if we ride it all the way to expiration and the option expires worthless, now your broker's platform is going to show that that obligation is now worthless. But the value of the cash didn't change, and now your total account value will show up as $10,200. To make things even more puzzling for traders, let's assume that these were the quotes on the option when you sold it. So you sold it at the current bid, but the asking price is $210. Well, depending on the broker, some might say your obligation is the price at where you sold, is $200, which is what I showed in the examples. Some might value it at the mark, the halfway point. But some brokers might say that your obligation is the asking price. Because if you sold the option, if you wanted to get out right now, the price where we know for sure that you can escape is the asking price. So they might actually value the obligation at $210. So watch what can happen. So your account value started at $10,000. You sell the option for $200, and your account value drops to $99.90. And traders are really puzzled now. Well, what happened is that yes, you did receive the $200 cash, but your broker marked the value of the obligation at $210. And so right now, in that very moment, you might actually see the value of your account drop. And it's only from the passage of time when you're going to see that cash collected to be fully reflected. So to answer the question, when do you receive the money? Well, technically you receive it immediately, but you don't realize it until expiration. And the reason is you must wait for that obligation to disappear. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.